take a look at what happens when the government places a tax on an item. So here you see a graph of supply and demand that are both relatively elastic. I'm going to highlight consumer surplus and producer surplus. Down here, as you know, is producer surplus. This is the amount that represents producers who are willing to produce a product for less, but were able to sell it for more money because equilibrium in the market was higher. So this will be producer surplus, and it is measured by the supply curve. Here you're going to see consumer surplus. Consumer surplus is on the top, and it's bounded by the demand curve. This represents the amount of consumers who were willing to pay more for a product but were able to get it for a good deal because equilibrium price was lower than their asking price. These two concepts are important because they represent efficiency in the market. The larger consumer and producer surpluses are, the more efficient our market is. And if you can maximize these so that they fill up the entire area between the supply and demand curves, you have a perfectly efficient market. But when we add tax to the mix, we're going to see some problems. So the first thing to know about tax is economists say that it shifts the supply curve up. Now, for most of us, we would consider that a shift to the left, but we call it a shift up because it isn't representing an increase in revenue on the behalf of producers or an increase or a decrease in savings on the behalf of consumers. It's also showing an amount of revenue that goes to a third party, in this case the government. So we shift our supply curve up by the amount of the tax. And in this case, I'm going to make it nice and easy and say that the tax was $1. So we're going to have a dollar tax that will increase our supply curve and shift it up by the amount of the tax. You can see our new equilibrium here at the dollar price is higher than our old equilibrium. The price went up in the market because when you go to check out and pay, the price is higher. But we've also got several other things that happen as a result of the tax. For one thing, you can see that consumer surplus gets smaller by the size of the tax. So consumer surplus has decreased as a result of this tax. And let's see if I can draw that in a little more clearly. Okay, so as you can see, the consumer surplus shrunk by this amount and producer surplus dropped this amount, but also at the new equilibrium, producer surplus should come up and fill in all of this area, but it doesn't because of the tax. And to look at where the tax is beneficial, at least to the government that's implementing it, you have to look at the area of government revenue. So here is what the government can make off of the tax. If you notice though, the government revenue is going to be a rectangle. It's going to be the amount of the tax, which was the distance between the old equilibrium and the new equilibrium. So in this case 1 times the quantity sold, which would be in this case maybe 3.75 or so. So when you multiply that out, you would get your area of government revenue, and you can see how much the government would make off of this tax. However, you see a whole area here that is left without any color, and this area is the amount of goods that are not produced because the tax caused the price of the good to be artificially high, and it caused consumers to drop out of the market and producers to drop out of the market. That is known as dead weight loss. So this area here is our deadweight loss, and you can see here the amount of pain that is caused to consumers and producers by the deadweight loss is split equally. That's because this tax had an equivalent amount of pain in the producer market and the consumer market. This government revenue is split on what's being taken out of producer pockets and what's being taken out of consumer pockets because both supply and demand were relatively elastic. Let's take a look at how that changes if demand becomes more inelastic. Okay, now I've redrawn the curves, and you can see here this elasticity of demand is much more inelastic. The curve is much more closer to a straight line or letter I than it was before. This will be an item that people are going to produce regardless, or purchase rather, regardless of the price. Things like gasoline or cigarettes or alcohol, addictive products, have a much more inelastic demand. And government often places a tax on these specific products. When it does that, it's called an excise tax, often a sin tax, because they're taxing people for producing products that they really don't feel that they can live without. So excise taxes exist on gasoline, alcohol, and cigarettes, and the government makes a nice tidy profit because they're well aware that people will continue purchasing these products regardless of price. However, you will have some loss to the market when that occurs. So here I'm drawing a nice supply curve for the incidence of the tax, and as you can see, the supply is going to shift directly upward by the amount of the tax. So if we added a tax of approximately $1, you'll notice that the supply shifted upward, and this tax is now in place. And you'll notice that the quantity sold is going to drop. So even though this is something people don't respond to very much in return to change in price, they do respond because the demand is not perfectly inelastic, it's only relatively inelastic. So you see that this went up. But look at what happened here in terms of consumer and producer surplus and government revenue. So the government revenue is now this area, and as you can notice, it's a good bit larger because of the inelasticity of demand. So the government revenue is taking over this area. And it's taken a very big bite out of consumer surplus. Our area here that is our deadweight loss, you notice, is very skewed in favor of consumers. So the deadweight loss means that more consumers actually pay the burden of this government revenue than producers do. So the tax has a much heavier weight on consumers, and that is reflected by what happens with our deadweight loss here. Consumers pay a good bit more of the tax revenue, and producers don't stop producing as much because they don't see nearly as much deadweight loss from the tax. So as you can see, with a less elastic demand, the government revenue is larger, and it has a much higher impact on consumers than it does on producers. Let's take a look at what happens when supply is less elastic. Okay, here we have an incident where supply is more inelastic and demand is more elastic. And what you can see is that our government revenue is right here in this area. So the government gets its piece of the tax, but it affects consumers and producers disproportionately. If you take a look here at deadweight loss, you can see that consumers are absorbing a bit of deadweight loss, but producers are absorbing the largest amount because producers can't take their product off the market in an instance of inelastic supply, where consumers can, of course, choose to stop buying that. So if we had an item like oranges where the government put in a tax after the crop had come in, producers are going to have to absorb the losses from that tax a great deal more, and their producer surplus is going to be much more cut than consumers would be. Because of that, the tax is going to disproportionately affect producers. So the kind of test question you'd see here is you might be given the elasticities of two items, and you would notice that the elasticity of supply is inelastic and the elasticity of demand is elastic. And what you could do is just draw out a sample graph and see what happens to this deadweight loss. If it's disproportionately large for producers, then producers take a larger hit, which happens when supply is inelastic. If it's disproportionately large for consumers, consumers take a larger hit, and that happened in our last example where demand was inelastic. Good luck, and I hope this helps.